folks, Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd reach out to you today with a brief market update, kind of let you know what's going on out there on Mr. Toad's wild ride of a market. For those of you who check the market on a daily basis, you will have noticed that we have seen what can only really be called sort of a meteoric rise over the past 20 days. S&P 500 right now at about 4,500 as I'm speaking. That's up 9.3% in 20 days. And it really just sort of highlights the volatility that's out there as the market tries to digest, are we headed towards higher interest rates? Are we headed towards a soft landing? We haven't quite gotten to the other side of, maybe the economy's too cold, but that might be coming. There's a lot that goes into that creates a whole lot of volatility and once again makes it very, very difficult to try and time this stuff. So I certainly hope that you haven't been trying. In terms of the explanation for that massive gain over the past couple of weeks, we've seen continued economic data that indicates a little bit of softness out there. After data through much of the fall, late summer, early fall, that indicated a very strong economy, strong labor market, strong, maybe a little bit stronger inflation trends than people wanted to see. We've seen over the past couple of weeks some softer employment reports, and then earlier this week, a softer CPI number. That CPI number running at 0.2% month over month in the core, which is once again all items excluding food and energy. That's really that number that the Fed likes to focus on in terms of overall inflation in the economy. That was a little weaker than people thought. People were looking for a 0.3% month over month, and the 0.2 is cause for much rejoicing. The narrative has thus shifted from, oh my goodness, maybe we need to raise rates even higher than they are now, to, hey, I've got a little bit softer unemployment, I've got a little bit softer consumer confidence, I've got a little bit softer CPI, and so maybe that means that rates can just stay where they are, and maybe actually you've even seen some people start to model in rate cuts starting in kind of the middle of 2024. And I just like to point out to everybody that economic data is variable. It is volatile. When we look at that core CPI number that I was just talking about, it bounces around a lot month to month. It's not uncommon if you look at a month-on-month chart to see it be herky-jerky over time. And even at 0.2%, we're still higher than the Fed's target rate. We really need to be down to 0 to 0.1% for an extended period of time before the Fed's going to be confident that we've kind of killed off the inflation that we need to kill off. Meanwhile, as the market is, trying to analyze, do we have really high interest rates for a long time, or are interest rates going to stay where they are and start to go down? They're making economic predictions that are, 6-7 months out. If you talk to the Chicago Fed president, Goolsbee, he would tell you he doesn't like to try and predict interest rates more than a month or 2 months out. Just based on the variability of that economic data. And so I just encourage everybody to take this most recent rally, the sell-off that preceded it, with a little bit of a grain of salt. We're kind of at an inflection point in the economy as we think about, is it growing too fast? Are we going to get the soft landing? It wouldn't surprise me if in a couple of months we started to hear people once again beat the drumbeat of maybe things are too soft. This is going to take time to work through, and it is once again an exceedingly difficult market to try and time. If you get it wrong on the timing, it's really, really punitive. As anybody who's been out of the market for the last 20 days knows, they've missed a 9% rally in the overall market. So not something that we encourage you to try and do. On the earnings side, I would be remiss if I didn't at least mention it. We're essentially done with third quarter earnings season. 467 companies out of the 500 in the S&P reporting. EPS came in at about plus 2.9% versus minus 1% expectations. That's a pretty good earnings season. It's obviously being overshadowed by the macro picture right now. But, I would say meeting expectations to slightly beating expectations. The market seems, pleased with those earnings numbers. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great week, and I look forward to talking to you again soon.